Good to have you. Nigeria's latest consumer price index figures are offering a mixed signal on the state of the economy. While the year-on-year headline inflation rate for April 2026 recorded a slight increase of 0.31% compared to March, month-on-month inflation, which slowed sharply to 2.13% from 4.18%, suggesting that immediate price pressures may be easing, even as broader inflation concerns persist. Now, the latest numbers also come amid a rise in inflationary pressures across several economies, including Ghana, South Africa, Kenya, and the United States, reinforcing arguments that inflation remains a global challenge driven by energy cost, supply chain pressures, and wider economic uncertainty. Joining us now to break down the April 2026 inflation figures, the global context behind rising prices, and what the outlook means for Nigerian households and policymakers is development economist and public policy analyst Ken Ife. Professor Ife, thanks for joining us.
Oh, thank you for having me.
Very good. Now, Professor, what are these current inflation figures telling you right now for Nigeria? How significant is it?
Well, I don't think it's terrible. First of all, let us agree on one thing, that the Nigerian Bureau Statistical Service, the Bureau has one of the most sophisticated research and statistical engine in the continent. And it has actually carried out its work in terms of rebasing the economy in 2014 and in 2024, both the GDP and the CPI, the inflation parameters, and that we have 5 major ones that tell different stories. We have the headline, you have the food, you have the core, you have the urban and they tell different stories on the inflation journey. So we need to be aware of those. And in terms of what has played out now, we all know that over the last 2 months, from February, end of February to now, oil politics and oil geopolitics and Iran have actually impacted inflation figures, but not in an alarming way for Nigeria, because we can digest the figures to show that we are still within the bounds. If you look at, you just mentioned the April figure and the March of the headline, showing just a marginal increase of 0.31%. But in terms of percentage of the original, it is about 2.13 compared to 4.18 of March. So which means that it is actually in real terms coming down. But even though the figure says 15.69, it is 15.69 relative to what it was a year before. So what actually describes the picture is what happened month to month, because what we are talking about is impact in March and April of what the crisis going on in the district. But that notwithstanding, if you look at the food and the energy are the most volatile items that actually drive the rise in inflation. So that is why they're excluded when you come to core inflation. And in fact, if you look at the food has gone up to 16.06. But remember that before the rebasing, the food was 39. After the rebasing, there was a haircut of about 10%. It came down and then it started to drop in the whole of 2025 until we have that inflection in December 2025. But now there is a slight uptick. But when he hit the lowest, food was 8.08 that time. So 18.8 now, 8.8 now is now back to 16.03. So it still shows you a drop. It went up about 1.75 compared to March. But the one that tells you a different story is the core inflation. The core inflation has actually come down, because it was 16.21 in March, but now it's 15.86. So you have a negative 0.35, which actually shows that we are having moderation in core inflation. Core inflation is every other parameter less the volatile items, which are energy and food. And so you can see what the impact. The energy goes up. And in fact, let me even tell you this. The energy going up, impact on energy is not relative to what it is in real term. Because if you look at petrol, PMS, LPG, they're all gone up by about 50%. Then you look at jet fuel, 300%. But what we are having is just small increase on the inflation parameters. So it might increase further in future, but now there's no cause for alarm as far as I can read these figures.
Very good, Professor. A marginal increase, you say, but how would you describe the current global context behind these latest figures? And even some African countries have had their own share of inflationary hikes.
Yeah, well, if you look at the countries you mentioned, like Ghana moved from 3.2 in March to 3.4. But when you look at the actual percentage change, it was actually 0.1% in March, but it jumped to 1%. So in April. So it's a significant jump from 0.1% to 1%. But then for South Africa, you have a rise from 3 to 3.1. I'm talking about their headline. In the US shows from 3.3 to 3.8, which was about 0.9% increase relatively in March, and then dropped to 0.6. US represents a different example because they are a net producer of fuel, and they are known to have extreme sensitivity to fuel prices. So they will do anything and everything to make sure they keep it down as much as possible. But Kenya is a slightly different story, again, in line with us. Kenya had 4.4% in March and 5.6% in April. So the rate of change for the March was 0.5%. But in April, it jumped to 1.4%, almost 300% increase. So you can see that our own there's moderation in our own figure. But I can tell you this, why we are having all these arguments is because we are still OPEC. We're still in OPEC. So OPEC is the benchmark is OPEC. Prices of products coming in and going out, all bench on OPEC. So there's very little room for the country to do much on these prices, except to tell the NNPC to give more crude to Dangote to refine, so that you can reduce the impact of imported inflation and all those stuff. So that is, and you've seen that something is going on there now. The president is actually keeping his word, and the NNPC is increasing the supply. But until we get out of OPEC, this thing will continue to persist. Look at Angola. Angola is 0.3% of dollar, so very, very low. And UAE took their own decision to get out of OPEC. OPEC is not relevant to what we are doing in Nigeria now. Our program is not about selling crude. It's about becoming a refining sovereignty so that we can focus on refined products and export them worldwide. They are not relevant to that. And then the emerging capacities now will be up to 3 million barrels a day. By the time you see NNPC coming back with 2 refineries live, and then you have Bua, 200,000 barrels and $50 billion going to Ondo, and Dangote doubling to 1.74 million barrels a day, we'll be looking for about 3 million barrels a day for refining. And OPEC is telling you to keep to 1.484. So that is a signal that things are not going to go very well in the future unless we get out of that OPEC bracket.
Would you still say inflation remains a common global challenge, even among developed economies as well? For example, the United States inflation rate in April this year was 3.8% year on year, and that's up from 3.3% in March of this same year. This was the highest U.S. inflation reading since 2023, and of course the monthly inflation was 0.6% from 0.9% in March 2026. I'd like your thoughts on that.
No, it will continue to be a major concern. Why? Because all those energies I mentioned to you, petrol, LPG, diesel, aviation fuel, they are experiencing, quantum increase. It's about 50%. And but the jet fuel is about 300% in Nigerian market. So those prices, they translate to high cost of transportation. And food is vulnerable to high cost of transportation because of our geography and our agroecology. Then you have other things. Most things, input costs to refiners. Generators are being used because of inadequate power supply. And then you also have issues, the impact on the, and what happens to petrol and happens to gas, because gas is what we use for much of our power generation. So all of those are translating to higher inflation, without a doubt. But it is manageable in countries that have oil like Nigeria, but it is terrible for other African countries that don't have any oil at all.
In view of the factors you just mentioned, Professor, do you envisage a period of uncertainty on account of these present inflationary trends, a sustained period for that matter?
Well, I think, as I said, it is going to continue to rise, but not in the case of Nigeria, not with a quantum jump, because I've given you the parameters so to see how we have come to where we are and how we are moving. But for many other countries, it's a completely different story, because they also don't have fiscal space. But we have a bit more fiscal space, because if you look at what Bola Tinubu did, he actually decapitated NNPC and asked all the oil companies to send the money direct to the federation account. So that is going to ease from June, and there's been more money. And from the time he went in 2023, the money going out to states to stabilize has gone from $700 billion a month to $2.1 billion, 300% increase. So all of these are resources being made available to fight for Nigeria. So we have more, we say borrowing though, so I'm not going to say we are still borrowing, which is a different story in itself, because fiscal discipline is a different story altogether. Indeed. So in all probability, there will still continue to be a slight increase until we have a restoration of normalcy in the oil something in the Middle East. But I still say that pressure will continue to rise in the case of Nigeria when OPEC continues to stay where it is. We haven't hit our OPEC quota anyway, 1.84 yet, but it is a signal that is waiting there. When other capacities come online, it will become a major issue for us.
Just before we let you go,
so the answer to your question is not that bad. It's not bad for Nigeria.
Okay, for the time being. Just before we let you go, Professor, what needs to change to ease price pressure to ensure a more tolerable standard of living, for average Nigerians, in view of all of what you've just mentioned?
So I didn't quite get the question. Sorry, if you can just repeat it.
Yes, what needs to change to ease price pressure, especially on energy concerns, as it were, to ensure a more tolerable standard of living for Nigerians?
Yeah, well, you know that it does affect standard of living, because if you look at all the indices, when you go to household baskets, you're going to see that thing on energy translates to input costs for manufactured goods. Manufactured goods go up in price. Then it affects transportation. Workers need transport to go to work. Then transportation of goods, food comes from thousands of kilometers away from the far north to the south. They are using petrol, they are using diesel, so that prices of goods are going up. It's all part of the impact of those energy. So the whole citizens will be at the receiving end of this. And that's why they are crying for palliative, they are crying for all kinds of interventions to cushion the effect. But as I said, we're even better off, because if we didn't have Dangote, we would have been paying 2,000 to 2,500 naira per liter of fuel. And then you will not even have it, because you would have had long queue. You would have had long queue and no available product. You would have been totally at the mercy of the marketers, just as you are seeing in A1, in jet fuel.
Indeed. Professor Ken Ufe, I would like to thank you very much for your thoughts on those issues. Good to have you with us. Many thanks for that.